Hare Krishna. Welcome to Tax YouTube channel. This is Sierra R. Pingle, practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Marks Network. And today we are going to discuss on a special topic, that is cash deposits in bank accounts, when it can be treated as income and when it cannot be. So let's dive into it. Let me allow to share my screen. Yes. So today we are going to discuss a very practical and increasingly important issue: cash deposits in bank accounts and their tax implication. So with the introduction of AIS, that is Annual Information System, TIS, Tax Information System, and advanced data analytics by the Income Tax Department, even small cash transactions are now under scrutiny. So a very common question arises: does depositing cash in bank accounts automatically mean taxable income or not? So the answer is not that simple. And that is exactly what we will decode today in this session, legally, practically, and through judicial interpretations. So, moving further, let's understand the basic concept of it. So, let us begin with the most fundamental principle. A cash deposit in bank account is not automatically your income. It is merely a movement of money from physical form to a banking channel. Clear what is meant? It is merely a movement of money from physical form to a banking channel. However, the Income Tax Act places a responsibility on the taxpayer, if questioned, to explain the source of such deposit. Okay. If the explanation is satisfactory, there is no tax implication on that particular deposit. So, but if the explanation is missing, whenever your case is selected for scrutiny, it will be weak case or not supported by evidence, then the same amount can be treated as your income. So the entire issue revolves around one word: explanation. Okay, let's understand legal framework. What are the relevant sections deals with it, the particular cash deposit? So let's understand the legal provisions on which such additions are under which such additions are made. So the Income Tax Act contains, that is Income Tax Act 1961 contains specific deeming provisions. Section 68, unexplained credits in books. Section 69, unexplained investments. Section 69A, unexplained money. Section 69B, investments not fully disclosed. And Section 69C, unexplained expenditure. So these are the deeming provisions, meaning even if it is not income in real sense, the law can deem it as income. In case of cash deposits, the most commonly used section is section 69A, that is unexplained money. So let's focus on that. Section 69A of the Income Tax Act 1961 is extremely important for our today's topic. It states that if a person is found to be the owner of the money, including cash deposits, and such money is not recorded in his books, and the assessee fails to explain the nature and source satisfactorily, then the said amount shall be deemed as income. Here used and means cumulative, both the conditions need to be fulfilled. That is, such money is not recorded in the books and the assessee fails to explain the nature and source satisfactorily, then and then only it will be added as income. So there are three critical elements here, that is ownership, non-recording in books, unsatisfactory explanation. Okay, you need to be own that money that is not recorded in your books and you are not satisfactorily explain it. So if these conditions are satisfied, then addition can be made. Let's see source states, three pillars. When explaining cash deposits, courts and tax authorities generally apply what three tests: identity, that is from where the money came, then the genuineness, there's the whether the transaction is real or not, and then the credit worthiness, whether the source had the capacity to produce that much amount of money, income, whatever. So in case of cash, these tests become what more practical. Was it from the past savings? Was it withdrawn earlier? Or was it from the business receipts? That particular part of the deposit, it's from whether it is from the past savings, whether it is from past withdrawal, or whether it is the from business receipt. So mere verbal explanation is not enough. It must be backed by the evidence or reasonable probability. That is what important. Let's moving further understand the when cash deposit is not taxable. It is very important to understand that many cash deposits are perfectly valid and not taxable, non-taxable. For example, cash withdrawn earlier and redeposited, past savings accumulated over the time and over the time and then deposited, then agricultural income, gifts received with the proper documentation, business receipts already recorded in books. So these are the kind of examples where cash that deposit cannot be treated as your income. The key is what? Consistency and the documentation. If the story matches the records, courts generally accept the explanation that need to be taken care of. Let's see what were the scrutiny triggers. So let us see how cases are selected for the scrutiny. So today the department uses what technology extensively. Okay. So common triggers include high value cash deposits reported in AIS, annual information system, then the demonetization period deposits, then the deposits inconsistent with the declared income, means deposit inconsistent with the declared income, whatever declared in the return of income. No return filed despite the large deposits. You are not filing the return of income. And then frequent deposits and withdrawals. So even if the taxpayer is small, the system flags unusual patterns automatically. And that will the system red flags or whatever flags it, it automatically comes under the scrutiny. So let's see common issues in scrutiny. In practical cases, additions are often made due to certain common mistakes. No cash book maintained, cash flow not reconciled, ignoring the earlier withdrawals, entire deposits tax instead of pick, and then the double addition. So many times the issue is not the transaction, but poor presentation or lack of records. So let's see peak credit theory. What is meant? One very important concept is that is the peak credit theory. If money is deposited, withdrawn, and redeposited, then taxing the entire deposits would be unfair. So instead of only the maximum unexplained balance at any point called peak should be taxed. So courts have consistently supported this approach. That is, so where there is a rotation of the funds, this becomes a very powerful defense. That is the peak theory. Let's see burden of proof. Whom with is it? The law places the initial burden on the assessee to prove that it is a clear cut deposits and also are able to explain the source of it. So the taxpayer must explain the source, as I said. However, once a reasonable explanation with evidence is given, the burden shifts to assessing officer to claim that that is the not genuine. So the AO cannot reject explanations arbitrarily. This principle is very important in litigations. Fairness must be maintained. Moving further, let's see what is meant by suspicion and versus evidence. A very strong judicial principle is that suspicion, however strong, cannot be replaced the evidence. So only suspicion doesn't require. It need to be go beyond it. Assessing officer may suspect but cannot make additions purely on that suspicion. There must be proper inquiry, supporting evidence, and logical reasoning also should be there. So this principle has been repeatedly upheld by the courts. So let's see what are the landmark rulings favorable to the assessee. Courts have given relief in many genuine cases, that is, cash deposit explained through earlier withdrawals. Then, in case of past savings accepted where the reasonable, and business cash deposits accepted if records in books. It's recorded in the books. So, courts understand real life situations very well, especially for small taxpayers, and apply a practical approach. Let's understand the technical part of the landmark rulings. Some important technical rulings like books cannot be ignored without the rejection. Peak credit must be considered. That peak credit theory must be considered. Entire deposits cannot be taxed blindly by the department. So these rulings are very useful while drafting our replies or appeals. Let's also see adverse judgments. So, on the other hand, courts have upheld additions where no evidence was provided, cash book was manipulated, explanations were inconsistent, arbitrary, entries were found to be bogus. So, the law is balanced. It protects the genuine taxpayers but penalizes the non-compliance too. Let's also understand the demonetization cases. So demonetization cases saw massive litigation that time in the year of 2016. Deposits made during the November and December 16 were heavily scrutinized. Courts accepted cases where cash sales were genuine, withdrawals were proven, but rejected cases where cash balances were inflated, records were created later. So timing and the credibility of the records also become the crucial in the case like this. So core question is cash deposit equal to taxable income or not? So answer is clearly no by default, but yes whenever if it is unexplained. So taxability depends entirely on your explanation. Let's see documentation checklist. What you need to be documented or maintained. To defend such cases, proper documentation is essential. Cash book, bank statements, cash flow statements, evidence of the withdrawals, and the supporting documents for gifts, agriculture, etc. A well-prepared file can prevent your litigation entirely. So let's see what will be the role of the professionals. So as a professional, our role is crucial here. Prepare explanation before the notice stage if anything is involved like this. Avoid contradictory submissions. Avoid what? Contradictory submissions. Apply judicial principles and use the pick theory wherever applicable. So proper strategy can make or break the case. So that need to be taken care of as a professionals. So let's see takeaways from the today's learning. To summarize, cash deposit is not directly treated as income automatically. Explanation is what your key. Documentation is the strongest defense. Courts support genuine taxpayers. So compliance plus clarity is equal to your safety. So I can conclude with a simple but a powerful thought here is that this transparency and documentation are the backbone of the best tax planning tools. If records are proper, even scrutiny becomes manageable. So that's it for today. If you have any questions, observations, suggestions, then do let me know via WhatsApp, email, or you can also comment below the video. Hope you are gaining the valuable knowledge from all such updates and video series which we are conducting on our Tax YouTube channel. So stay tuned to the Tax YouTube channel. If you are not yet subscribed, then do subscribe, like, and share the videos. Thank you. Thank you so much once again. Bye bye. Take care. See you soon. Hare Krishna.